Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. As promised in yesterday's video, today we are going to discuss hidden supply and demand levels within candlestick patterns. But if you haven't watched yesterday's video, I'd like to highly urge you to take 10 minutes before watching this video and watch that one first. The link will be in the description down below. Now, if you're a successful trader, you already know supply and demand is the foundation of any financial market. Each candle is formed based on the battle of supply versus demand. So it's crucial for us to be able to spot these on the charts, and as many of you know, the supply and demand zones that we identify are based on your typical rally-based rally or drop-based drop formations. In Market Structure Part 3, which was the video that we actually hosted live, we went into some details about rally-based rallies and drop-based drops, so hopefully majority of you have actually watched that video and hopefully you have a good understanding of what drop-based drops and rally-based rallies are. But as a quick refresher, especially for those of you who might still not have a clear understanding of what drop-based drops and rally-based rallies are, let's go ahead and quickly speak about what the behavior actually looks like. So generally speaking, what we mean by a drop-based drop formation is where you have a decline in the market. For a few candles, the market goes into a consolidation range, goes into a sideways move. However, you can see the continuation of that decline straight after. Now, as you can imagine, within this range that the market has gone sideways, there must have been new orders accumulated on the sell side to be able to push this market further down. That's why a lot of times you even hear us refer to drop-based drops as areas of redistribution of price, because that's quite literally what's taking place in that region. There is, in a way, new supply being introduced. Now, the most accurate areas of supply are those that have invalidated previous major demand. Oftentimes you will find, as the market needs to redistribute the price to drive it lower, if this level is meant to get respected in the future, oftentimes you will see that this level has invalidated a very strong level of accumulation or very strong level of demand. And obviously, for those of you who trade drop-based drops and rally-based rallies and have been doing that for so long, these are no new concepts. You already know that similar to how we trade institutional candles, waiting for a pullback to, in a way, mitigate that level, that's exactly how we would be trading drop-based drops as well. So let's say you've identified your significant area of supply, you simply wait for some type of a retracement onto that level. Upon lower time frame confirmations at that level, you'll be able to go ahead and actually assume sell positions and take advantage of the move. As a general understanding, by lower time frame confirmation, we mean things like invalidation of the relative demand approaching that level, or in other words, a break of structure to the downside. Some people look at distribution, so on and so forth. All of these other concepts that we've actually discussed previously. I'm not going to dive deep into it in this video. So if drop-based drops gives us area of supply, rally-based rallies will give us areas of demand. And the same way you would be trading your drop-based drops, you can be trading your rally-based rallies as well. So for example, within these areas of reaccumulation, the areas of rally-based rally that are extremely important, or those reaccumulations that are extremely important, that make it more likely for the market to respect them in the future, are those that have invalidated significant areas of supply. Now, yet again, within these areas of rally-based rally, you don't necessarily need it to just be one candle or two candle or three candles. We say a few candles, but in reality, if you take that level and look at it on the lower time frames, you will get a bunch of them within the reaccumulation region. So it's really, really relevant to the time frame that you're looking at. But more than anything else, it's about the price behavior. It's about how the market has actually stalled within that impulsive range and then continued the move higher after that, showing that at that given level, there were new orders accumulated. And by new orders accumulated, I'm talking from an institutional perspective. I'm not talking about the retail orders being accumulated. In the typical supply and demand teachings, we are told to mostly use them on the higher time frames. So that's why you see a lot of the times people would use them on the 4-hour, daily, weekly time frames and consider those higher time frame areas of reversal. But I'd like to remind everyone that the markets are fractal. Whether you're looking at the monthly time frame or the 1-second time frame, the same price behavior will repeat itself. On the 1-minute time frame, it still needs to take the highs or take the lows. For it to take the highs and take the lows, relative supply and demand need to be introduced. The same thing needs to happen on the monthly time frame. So the same picture repeats itself on all different time frames. Now, this video is meant to highlight the similarities of some candlestick patterns to supply and demand. So let's quickly speak about the formations that we did not discuss yesterday. One of those formations was the inside bar formation. And in the candlestick pattern rule, how the inside bar formation looks, or the behavior behind it, is when you have a candle engulfing the candles after that. This is called the mother bar inside bar formation as well. So this would be our mother bar, and all of these other candles would be the inside bar formation. So they are actually contained within the range of that mother bar. This pattern could be both a reversal and a continuation formation depending on where it's formed. For example, if you have the market coming up and then you have your mother bar, you have your inside bars in the middle, and then the continuation higher after that outside of that mother bar, that is now looked at as the continuation pattern in the rules of the candlestick formations. On the other hand, if you have, for example, the market coming up and you have a mother bar inside bar formation at the top of the range and you can see it break below, normally this is now looked at as a reversal formation and you'd expect to be trading this lower. By the way, as you can imagine, there would be the other side to this formation as well, where you have the mother bar as the bearish candle that's completely containing the candles after that, and then you have the market moving outside of that range, pushing it lower. So this kind of mother bar inside bar formation is the same formation, just the other way, in a way the market breaking completely outside the other way around. Now what's interesting to see is this mother bar inside bar formation is extremely similar in its behavior, if not completely identical, to our drop-based drops and rally-based rallies. Now in the textbook teachings of how you actually trade the inside bar formation, you actually execute your sell position upon the break outside of your range. So a lot of people would go ahead and identify that mother bar, the inside bars in the middle, and in a lot of cases actually people would put buy stops at the top and sell stops at the bottom to be able to catch this whichever direction that it goes. Now I'm not sure how many of you have traded that way, but if you have, you would agree with me when I say it's a bit of a hit or miss. This typical teaching of wait until it breaks and trade it accordingly does not agree with how we trade drop-based drops and rally-based rallies, because in reality, as this candle is forming, how can you possibly know if it is going to completely close outside of that range, if it's going to prove to you that indeed, yes, this is going to push the price lower? What if it just wants to dip a little bit lower and then come back up? Maybe it wants to grab liquidity down here and then close a little bit further up. That becomes the issue. So for us as supply and demand traders, in a way, the whole analysis is very similar to these mother bar inside bar formations, with the difference that we wait for that level of supply to prove to us that it's still active, and then we assume the risk and then we take the trade. It's not just the inside bar formation that we did not speak about yesterday. We also didn't speak about the doji formations. This one's pretty easy, pretty straightforward. All of you know exactly what it is. The doji candle is very simply a candle that has the same wick on both sides, and practically the open and the close price of that body is at the same level. So it's a very indecisive candle. Why? Because it kind of shows that equilibrium, as if the price was pushed up, then pushed back down, but it ended up maintaining it at the same level. So in a way, that whole candle, it shows that the bullish side, the bearish side has been equal. They've kind of cancelled each other out. So doji is kind of very simple to look at. But adding on to doji, we have the final two formations that I didn't speak about. We have the morning star formation and the evening star formation. The morning star formation is one that forms at the bottom of the range, again a reversal formation. And the idea behind this three candle formation is the first candle is pushing the price down, supporting that previous trend. The second candle shows a very indecisive market. It could be a doji candle, it could be a very small body candle. It doesn't really matter whether it's bullish or bearish, as long as the whole range of that candle shows indecisiveness. It doesn't necessarily show any more momentum. And after that, if the market goes and reverses and heads higher, especially if the candle after is much bigger than the move to the downside, we consider that the morning star formation. And in the textbook teachings, that actually points towards a bullish market. And the evening star formation that takes place at the top of the range is again the same thing. It's a three candle formation where the first candle is simply following through with the previous trend, just simply pushing higher and higher. You see an indecisive candle and the third candle which pushes down heavily, showing that potentially at that indecisiveness there was some type of an equilibrium between supply and demand, or between the buyers and sellers, and then the candle after that has now pushed it lower, making the sellers a little bit more in control of the market. Now the same way the inside bar formation is similar to drop-based drops and rally-based rallies, there are two other supply and demand levels as well that are known as rally-based drops. So the market goes up, creates the base, and then drops, or the drop base rallies as well. In the market structure part 3 videos, we spoke about this as obviously the distribution at the top and the accumulation at the bottom. So now, putting these next to each other, hopefully you can now see the similarities also between the morning star formation and the drop base rally formation, or the evening star formation as the rally base drop formation. Sometimes it might not look as clean as this evening star formation here, but you could tell that there was an element of supply introduced at the top over there, because maybe it just invalidated a strong level of demand over here. And these are the times that you wait for some type of a pullback to your significant areas, and then you want to trade this to the downside accordingly. Now, if you have never looked into drop-based drops and rally-based rallies or supply and demand before, but you have looked into candlestick formations, hopefully now you know that you most definitely have at least the foundational knowledge when it comes to supply and demand. But you definitely know a lot more than you think you do. It's very interesting to see how these drop-based drops, rally-based rallies, or supply and demand levels that we trade based on is very similar, in fact identical, the same thing as all of the candlestick formations that have been used for quite literally decades, more than that. Before we wrap up the video, I just want to show a few examples as to how drop-based drops and rally-based rallies can look different on different time frames, so you don't always just follow the pattern. You know how much I hate these pattern tradings. I want to teach you to trade the behavior. More than anything else, I like to encourage each and every single one of you to go and find examples for yourself, backtest this properly. I have a video about how to backtest and practice trading properly, so go ahead and watch that one if you don't know how to do it. But hopefully the next couple examples would shine a little bit of light onto what I mean about everything that I've said in this video. This is an example of a rally-based rally on the 8-hour time frame. You can see that the market has rallied, has gone sideways in a few candles, not much movement, and the continuation outside. And this indeed is a very strong level of demand, simply because it has invalidated previous areas of supply. You can see that from there, it sponsored the price to create a complete new high. So it's no surprise for us to now be able to see that the market pulls back into these levels before taking off higher. Now on the 4-hour time frame, it goes without saying you're going to have more candles in that base than the 8-hour time frame. On the 8-hour time frame, it looks like a 2-candle base over there, but it's still the same thing. And right as it came back down as well, it started to create a drop base rally formation. So over here, the market has declined into that level of demand, has gone sideways, created its base, created its accumulation range, and started to take off after that. Again, this is now on the 8-hour time frame, but if I zoom out to the daily time frame and look at that same level, I don't think I now need to point anything out to what this looks like. We literally have just gone through this 3-candle formation. You can see it right over here. Now going back to the 4-hour time frame, looking at that general drop base rally, remember what I was talking about as well. When it comes to these areas of demand, they're going to be respected, or if they're not going to be respected, if they're going to be invalidated, most likely you will get some type of a distribution to sponsor the price below there. And this is exactly what's happening over here as well. Your general distribution range that's taking place, or redistribution range that's actually taking place to start to invalidate this level lower. And surprise, surprise, if you look at that same level on the daily time frame, you will be able to see now a drop base drop formation. Another example would be on the hourly time frame. We can have a look at what we have up here as well as an example of a drop base drop. Now this might not look like the most clear base to a lot of people. A lot of people might be slightly confused as to why we are calling this the base. This is still our base. This is still that slow moving market that's being formed in a way to accumulate more sell orders, accumulate more bearishness, if that's even a word, for the market to be pushed lower. But that same level now on the 4-hour time frame looks like your clear area of drop base drop. And you can see after that, the market indeed comes up to mitigate that drop base drop, and down it goes. Now, sometimes the drop base drops don't even necessarily have candles in them, meaning on different time frames, you might not even be able to see the base clearly. For example, on the 4-hour time frame, I'm going to go ahead and identify this range from the low of this candle to the high of this candle. And the reason I'm picking this, by the way, is because I know a lot of you are wondering, hang on a second, this looks like a morning star formation over here. Isn't this a drop base rally, meaning the market is meant to touch here and reverse after that? Well, normally we would expect this, but to be honest with you, in this case, as you can see, the drop base rally, it did not invalidate any significant supply. It actually ended up respecting that previous supply, and on its way down, it created a drop base drop, invalidating that area of demand. And you might be wondering, hang on, that's not a drop base drop. Where is your base? On the 4-hour time frame, you can't see it. But that range on the 2-hour time frame is your very clean, very clear drop base drop formation. I personally don't like to just sell blindly at these levels. As I mentioned, I like to see the lower time frame confirmations. For example, what we spoke about was invalidation of demand. So when this market actually approached this level of drop base drop over there, indeed we got the initial reaction, but this stayed respectful of this previous area of demand that sponsored the price higher. It did not give us that quote unquote break of structure, so we shouldn't be surprised to see another push higher than that drop base drop into our original area of supply, sponsoring the price then lower than our areas of demand, and then lower than that, and lower and lower. The purpose of this video and the video that I posted yesterday was for you to actually be able to spot behaviors and not patterns, for you to realize that things look different on different time frames, but the behavior is the same thing. So I really do hope a lot of you actually can put these two videos next to each other, add these to your backtesting, and start to see the market from a slightly different perspective, hopefully shining a little bit more light onto the matter of how you can trade supply and demand, and how you can even mix some of the candlestick patterns with supply and demand if you wish to do so. But with that being said, if you got value from the video, don't forget to press the like button down below, subscribe to the channel if you're new, welcome to our family and welcome to our community. My Instagram, and my only Instagram, is at Pips of Persia. There is no dots, no underscores, nothing, and it goes without saying, I will never ever ask you for investment. So please do not fall for the fake comments, don't fall for the fake accounts, and keep your money safe. So with that being said, let's elevate and let's catch some pips.